The FlexFirst Home Equity Line of Credit, HELOC, at First National Bank of America is a game-changing loan product for the financially disciplined borrower. This product combines a mortgage, a HELOC, and an FNBA checking account into one package, simplifying your finances, providing access to the equity in your home, and the potential to save money on interest over time. But how exactly does it do all of those things? Well, that's a great question. The FlexFirst HELOC is unique in that the funds deposited into the checking account are swept out and applied to the loan daily. If a monthly payment is due, the funds swept from the checking account will pay the current monthly payment of interest and escrow. Then any amount swept in excess of the current monthly payment will be applied to the principal balance on the loan. Deposits made to the checking account after the current monthly payment has been paid will be swept to the line of credit and applied to the outstanding principal balance. The funds deposited can consist of things like direct deposits of your payroll, daily deposits of your business earnings, automatic transfers from an account you have at another bank, or personal deposits like checks from friends and family. This checking account is linked to your home equity line of credit, which you could use for your daily expenses, monthly bills, and anything else that you would normally use a checking account for. I know this sounds confusing, but trust me, it's really quite simple. Now let's take a look at two different scenarios to see how a FlexFirst HELOC can make an impact. For both scenarios that we are about to run through, we are going to use a mortgage amount of $400,000 and a monthly income of $10,000. These scenarios would work the same way regardless of whether the FlexFirst HELOC was used to purchase or refinance a home. In scenario 1, the household has a $400,000 mortgage and earns $10,000 each month. When their paycheck or other income is deposited into the linked checking account, a sweep takes place automatically, paying down the FlexFirst principal balance. Now that this money has been swept into the account, the remaining balance is $390,000. At first glance, this seems like progress because the loan balance dips whenever deposits are made. But here's the challenge. The household in scenario 1 spends $8,500 per month on bills and expenses. It should be noted that this monthly spending does not include their current mortgage. As the weeks go by, the bills are paid for using the available equity in the HELOC, which means by the end of the month, the loan balance has risen back to $398,500. The sweep account is functioning as intended, but with so little cash left over, there's no real impact on reducing the mortgage. Now let's take a look at scenario 2. This household has a $400,000 mortgage and the same $10,000 in monthly income. Just like in scenario 1, their deposits sweep into the HELOC and lower the balance to $390,000. The difference between scenario 1 and scenario 2 are their expenses, which are only $5,000 each month. After all of their expenses, they are left with a loan balance of $395,000. Instead of rising back to nearly the original balance like in scenario 1, their principal balance consistently declines at a much faster rate. The FlexFirst HELOC from FNBA makes your money work harder for you every single day. It reduces interest costs as deposits come in, keeps your equity available for when you need it, and brings your mortgage and checking account together into one simple package. If you're like the household in scenario 2, with a steady income, lower expenses, and extra cash each month, a FlexFirst HELOC from First National Bank of America could be right for you.